committed to restoring the inflation growth balance in the overall interest of the economy. Accordingly, the MPC decided to keep the policy repo rate unchanged at 6.5% in this meeting, and also to continue with the neutral stance of monetary policy, as it provides flexibility to monitor and assess the outlook on inflation and growth, and then go on to act appropriately. I would now like to provide an assessment of growth and inflation, and I would like to begin with the global growth scenario. The global economy has shown unusual resilience in 2024, despite several headwinds. Inflation is gradually moving towards the target from its multi-decadal highs, prompting several central banks to embark on policy pivots. Global trade remains resilient, with increasing volumes confined within geographical blocks. Since the last MPC meeting, financial markets have remained edgy amidst rising US dollar and hardening bond yields, resulting in large capital outflows from emerging markets and also in volatility in equity markets. Going forward, the outlook is clouded by rising tendencies of protectionism. I'm talking about the global economy. Going forward, the outlook is clouded by rising tendencies of protectionism, which have the potential to undermine global growth and also push inflation higher. Let me now turn to the domestic growth situation. Growth in real GDP in the second quarter of this year at 5.4% turned out to be much lower than anticipated. This decline in growth was caused mainly by a substantial deceleration in the industrial growth from 7.4% in the first quarter to 2.1% in the second quarter due to subdued performance of manufacturing companies, contraction in mining activity, and lower electricity demand. The weaknesses in the manufacturing sector, however, was not broad-based, but was limited to specific sectors such as petroleum products, iron and steel, and cement. Going forward, high-frequency indicators available so far suggest that the slowdown in domestic economic activity bottomed out in the second quarter of this year, and it has since recovered, aided by strong festive demand and pickup in rural activities. Agricultural growth is supported by healthy kharif crop production, higher reservoir levels, and better rabi sowing. Industrial activity is expected to normalize and recover from the lows of the previous quarter. The end of the monsoon season and the expected pickup in government capital expenditure may also provide some impetus to cement as well as iron and steel sectors. Mining and electricity are also expected to normalize post the monsoon-related disruptions. I specifically commented on these sectors, that is on manufacturing, on electricity, and also on mining and iron and steel, as well as on cement, because these were the sectors, particularly in manufacturing, mining, and electricity demand, which were the principal factors which pulled down the GDP number in second quarter. So that's why I have focused how these three sectors are expected to behave in the current quarter as well as in the next quarter. The Purchasing Managers Index, that is PMI for manufacturing at 56.5 for November, remained elevated. The supply chain pressures eased in October-November and fell below the historical average. The services sector continues to grow at a strong pace. PMI services remained steady at 58.4 in November, indicating continued expansion. On the demand side, rural demand is trending upwards, while urban demand shows some moderation on a high base. Government consumption is improving. Investment activity is also expected to improve. On the external front, merchandise exports expanded by 17.2% in October, while services exports continued to post upbeat growth at 22.3% in October. Taking all these factors into consideration, real GDP growth for 2024-25, that is the current year, is now projected at 6.6%, with Q3 at 6.8% and Q4 at 7.2%. Real GDP growth for the first quarter of 25-26 is projected at 6.9% and the second quarter of 25-26 at 7.3%. The risks are evenly balanced. I would now like to focus on inflation. Inflation increased sharply in September and October 2024, led by an unanticipated increase in food prices. Core inflation, though at subdued levels, also registered a pickup in October. Fuel group remained in deflation for the 14th consecutive month in October. In the near term, despite some softening, lingering food price pressures are likely to keep headline inflation elevated in the third quarter, that is, in the quarter October to December. Going ahead, a good Rabi season would be critical to the softening of food inflation pressures. Early indications point to adequate soil moisture content and reservoir levels, conducive for Rabi sowing. The estimates of record Kharif production should bring relief to elevated prices of rice and tur dal in particular. Vegetable prices are also expected to see a seasonal winter correction. On the upside, the evolving trajectory of domestic edible oil prices following the hike in import duties and rise in their global prices need to be monitored closely. Manufacturing and services firms surveyed by the Reserve Bank point to firming up of input costs and selling prices in the fourth quarter of the current financial year, that is in the quarter January to March. Taking all these factors into consideration, CPI inflation for the current financial year, that is 24-25, is projected at 4.8%, with Q3 at 5.7%, Q4 at 4.5%. Going into the next financial year, CPI inflation for the first quarter of 25-26 is projected at 4.6% and Q2 at 4%. The risks are evenly balanced. Now, what do these inflation and growth conditions mean for monetary policy? I have described the growth conditions. I have described the inflation conditions. Now, what do all these factors mean for monetary policy? And that is what I would like to now highlight. The near-term inflation and growth outcomes in India have turned somewhat adverse since the last monetary policy in October. The medium-term prognosis on inflation suggests further alignment with the target, while growth is expected to pick up its momentum. Persistent high inflation reduces the purchasing power of consumers and adversely affects both consumption and investment demand. The overall implication of these factors for growth is negative. Therefore, price stability is essential for sustained growth. On the other hand, a growth slowdown, if it lingers beyond a point, may need policy support. The Reserve Bank's anti-inflationary monetary policy stance has been a crucial factor in bringing about a significant disinflation. Going forward, as food price shocks wane, headline inflation is expected to ease and realign with the target as per our projections, which I just read out. At present, it is necessary to draw on the flexibility provided by the neutral stance of monetary policy to wait for and monitor the incoming data for confirmation of the decline in inflation. The gains achieved so far in the broad direction of disinflation, notwithstanding the recent upticks, need to be preserved. At the same time, the growth trajectory and the evolving outlook also need to be monitored very closely. At this critical juncture, prudence and practicality demand that we remain careful and sensitive to the dynamically evolving situation with all its complexities and ramifications. A status quo in monetary policy in this meeting of the MPC has thus become appropriate and essential. I would now like to turn to liquidity and financial market conditions. System liquidity as represented by the net position under the LAF, that is net liquidity adjustment facility, it continued to remain in surplus during October and November on account of higher government spending, despite a significant increase in currency in circulation during the festive season and capital flows. Of course, towards the end of November, for a few days, the liquidity became tight, but overall, I think there was adequate liquidity both in October and November, and it remained in surplus. Given these conditions, the Reserve Bank mainly conducted variable rate reverse repo operations, that is VRRR operations, to absorb surplus liquidity. To alleviate temporary liquidity tightness because of large GST outflows, however, fine-tuning variable rate repo operations, that is VRR operations, were conducted intermittently during October and November. The two-way liquidity operations of the Reserve Bank ensured close alignment of the interbank overnight rate with the policy repo rate. Transmission to the credit market has been satisfactory. As you would have noticed, as in the previous monetary policy statements, lot of data is given in the footnotes. So those of you who are interested may have a look at the footnotes, because the data in the footnotes justify and back up whatever I am saying as a part of my statement. Now, even as liquidity in the banking system remains adequate, system liquidity may tighten in the coming months due to tax outflows, increase in currency in circulation, and volatility in capital flows. To ease the potential liquidity stress, it has now been decided to reduce the cash reserve ratio, that is, to reduce the CRR of all banks to 4% of net demand and time liabilities, that is NDTL. And this will be done in two equal tranches of 25 basis points each, with effect from the fortnight beginning December 14th and December 28th. This will restore the CRR to 4% of NDTL, which was in fact the prevailing rate before commencement of the policy tightening cycle in April 2022. The reduction in CRR is consistent with the neutral policy stance and would increase primary liquidity of about rupees 1.16 lakh crore, that is 1,16,000 crore to the banking system. Going forward, the Reserve Bank will continue to be nimble and proactive in its liquidity management operations to ensure that money market interest rates evolve in an orderly manner and the productive requirements of the economy are met. During 2024-25, that is from the period April to November, the Indian rupee depreciated by 1.3%, largely due to pressure from strengthening US dollar and selling pressure by foreign portfolio investors, especially in October and November. Nevertheless, both the depreciation of the Indian rupee and its volatility was less compared to its EME peers. And this reflects India's strong macroeconomic fundamentals and improvement in the external sector outlook. The Reserve Bank's exchange rate policy has remained
Master
consistent
your money.
over the
Personal
years,
finance
and it
workshop
is
on mutual
market
funds on
determined.
December 7th and 8th.
Its
Register
central
now.
tenet is to maintain orderliness and stability without compromising market efficiency. Foreign exchange reserves are deployed judiciously to mitigate undue volatility, maintain market confidence, anchor expectations, and preserve overall financial stability. These interventions focus on smoothing excessive and disruptive volatility rather than targeting any specific exchange rate level or band. At the same time, our effort to deepen and modernize the foreign exchange market have also yielded significant results in terms of, first, widening access and participation, and second, ensuring efficiency and ensuring efficient price discovery. Our overall approach ensures that forex reserves act as shock absorbers, safeguarding the economy from external spillovers while supporting competitive and orderly market conditions. The flexible or market-determined exchange rate regime is not merely a tool for managing external shocks. It is an important element of our approach to macroeconomic and financial stability. By combining market discipline with prudent intervention, we have created a system that supports stability, resilience, and growth. Let me now focus on financial stability. The financial parameters of banks and NBFCs continue to be strong. The incoming data suggest that the gap between growth of credit and deposits of scheduled commercial banks has narrowed, with deposits keeping pace with loan growth. In fact, on the financial sector, I can say with confidence that I think the health of the financial sector today is perhaps at one of its best in a long time. The Reserve Bank supervision of the financial sector and its entities continues to be vigilant and proactive. Incipient signs of stress, if any, either at the systemic or entity levels, are monitored closely and proactive action is initiated. The effort is always to resolve the issues non-disruptively. Continuous engagement is held over several months, sometimes even exceeding 1 year, with the regulated entities. Only in extreme cases where sufficient corrective action is not visible, the Reserve Bank resorts to imposition of business restrictions as a last resort in the interest of consumers and financial stability. In fact, there are a large number of entities where the corrective action is taken and where we simply do not take any action because the response by the regulated entities is found to be very proactive and very responsive. And so in many cases, without imposing any restrictions on their business or other kinds of activities, the problem gets resolved. Obviously, the list is not known outside. That list is much longer. And the total number of entities, I'm not being defensive about it or in any way. Why I'm emphasizing on this is that this is something which we have to do in the interest of stability of the system as well as the stability and health of the individual entities. So only in extreme cases where sufficient corrective action is not visible, the Reserve Bank resorts to imposition of business restrictions as a last resort in the interest of consumers and financial stability. To address the issues of unclaimed deposits, inoperative accounts, and frozen accounts due to pendency of KYC updation, banks have been advised very recently once again to take necessary steps urgently to bring down the number of such accounts and make the process hassle-free. Further, banks have been advised to segregate the accounts of beneficiaries of various central and state government schemes through direct benefit transfer, that is DBT, and facilitate uninterrupted credit of the DBT amounts accounts and also utilization of the DBT amounts by the account holders. And we have advised the banks to do it without inconveniencing such vulnerable segments of customers, because the DBT beneficiaries are usually, and they are the vulnerable sections of the society. So being fully mindful of that, we have emphasized that there should be a kind of a seamless and smooth flow of DBT amounts into the bank accounts of such individuals in a situation so that it facilitates the individuals to withdraw the money to meet their various requirements. Progress made by individual banks in this regard will be monitored by the Reserve Bank. I would now like to turn to the external sector.
సో H1B వర్క్ వీసాలో ప్రాబబిలిటీ అయిపోయింది, ఎంతమంది అప్లై చేస్తున్నారు దానికంటే చాలా 5 times తక్కువ వీసాలు ఉన్నాయి. సో ఈబీ ఫైల్ అడ్వాంటేజ్ ఏంటి అంటే నువ్వు ఆల్ అక్రాస్
India's merchandise exports expanded at a 28-month high pace.
మోర్ ఓవర్ ఏంటంటే
Merchandise imports
ఇండియాకి
also
యుఎస్
increased for
కి
the
కూడా
consecutive
ట్రావెల్
month.
చేయొచ్చు, ఎటువంటి
Services
రెస్ట్రిక్షన్స్
exports
ఉండదు. ఎందుకంటే మనకి
sustained
ట్రావెల్
buoyancy
కి రిలేటెడ్
and
అడ్వాన్స్
posed
పేరోల్ అప్లికేషన్
double-digit
వేయడం
growth
జరిగింది
in second
కాబట్టి
quarter
అప్లికేషన్
as well
అప్రూవ్
as in
అయింది కాబట్టి దాన్ని బేస్
October
చేసుకొని మనం
2024.
అటు ఇటు
The
ట్రావెల్
robust
చేయొచ్చు. మోర్ ఆర్
services
కండిషనల్
exports
గ్రీన్ కార్డ్ వచ్చాక
together
ట్రావెల్
with
రెస్ట్రిక్షన్స్
strong
అనేవి ఏమి
remittance
ఉండదు, అక్కడైనా
receipts
ఎక్కడైనా
are
వర్క్
expected
చేసుకోవచ్చు.
to
అదే
keep the current
అడ్వాంటేజ్
account
అన్నమాట
deficit
EB5 వీసాలో.
within sustainable
సో
levels during
మనకి
24-25.
వర్క్ చేసే
On the external financing
ప్రతి
side,
వీసా
gross
ఒక్కొక్క వీసాకి
FDI
ఒక్కొక్క క్లాసిఫికేషన్
to India
ఉంటుంది.
increased
అసలు
at a
విజిట్
robust
వీసా
pace.
మీద
I'm talking about
వెళ్ళినాళ్ళు
gross.
అంటే
The gross
విజిట్ వీసా
FDI
అనగానే మనకి
into
B1
India
or B2
increased at a
like
robust pace
tourism and
during the
visit
first
visa
half of
అనుకుందాం.
the year.
Like let's say
Net
కొంతమంది
FDI,
business
however,
purposes కి
moderated
వెళ్ళొచ్చు.
during this period due to
Conferences
higher
కానీ
repatriations
సెమినార్స్ కానీ
and
లేదా
rising
జాబ్
outward
ఇంటర్వ్యూస్ కి
FDI.
అలాంటి వాటికి
Foreign
వెళ్ళొచ్చు.
portfolio investment,
అలానే
that is
మెడికల్
FPI
పర్పస్ కి
inflows
ఆపరేషన్స్
to
చేయించుకోవాలన్నా
EMEs
అలాంటి
have
వాటికి కూడా
generally
వెళ్ళొచ్చు.
declined in October.
సో చాలా మంది
Net
ఏమనుకుంటారంటే
FPI
విజిట్
inflows to
వీసా మీద
India
వెళ్ళి అక్కడ వర్క్ చేయొచ్చు
stands
అనుకుంటారు,
at
వర్క్ చేయకూడదు.
US dollar
ఇల్లీగల్ టు వర్క్ దేర్.
9.3 billion.
ఎందుకు
So
అంటే
far in the
విజిట్
current
వీసా
year,
ఆర్
that is
టూరిజం
from
వీసా అనేది ద
April
పర్పస్
to December
మనకి ఎందుకు
4th.
ఇస్తున్నారు అంటే
And this was
టూరిజం వల్ల
supported
వాళ్ళకి
mainly by
రెవెన్యూ
inflows
పెరిగింది,
in
లేకపోతే
the debt
ఏదైనా
segment.
యాక్టివిటీస్
External commercial borrowings and
ఏదైనా రిలేషన్స్
non-resident
బిజినెస్
deposits,
రిలేషన్స్
on
కానీ
the other hand,
లేకపోతే
witnessed
ఏదైనా
higher
కాన్ఫరెన్స్
net
సెమినార్స్
inflows
కి వెళ్ళడం
compared
వల్ల
to the
అక్కడ
last year.
కైండ్ ఆఫ్
India's
ఎడ్యుకేటింగ్
external sector
జరుగుతుంది, అంటే
remains
అక్కడ
resilient
ఫెసిలిటేషన్
as
జరుగుతుంది.
reflected in various
బట్
key
మనకి
indicators where
కొంతమంది ఏం
India has
చేస్తారు